Hey guys, good morning. Okay. Let's slowly go back to our seats as we go into the upstream, onshore, and unconventional panels. We're going to start with a little bit of our 6 key insights. I'm Maria. I work here at ADI as a senior analyst since January last year. So, to start, shale is maturing, and this will be, all the consequences and implications will be well discussed in this panel. But what we wanted to point here is that different from shale in its infancy, where we're all about exploration and play delineation, Shale 3.0 is more about operators practicing capital discipline for sustainable growth, and actually taking a more engineering approach where they are mainly focusing on investing in technologies to maximize recovery as premium acreage decreases. Another consequence of U.S. shale plays aging are the increase in water cuts. Here we can see that in the Permian, for instance, 24% of the wells are producing less than 50 barrels of oil per day, but then the water cuts could be anywhere from 30 to 95%. That will drive operators to mainly invest in artificial lift or production chemicals. So here we have another graph on produced and recycled water volumes in the Permian. We see that the water volumes are increasing through the years, but the produced water recycle is around 20% or less, and this will drive operators to invest in water management. Oops. Changing a little bit from shifting to deep water, we see there is a decrease in exploration spending through the years, and this is exemplified by the graph where we show that majors providing spending guidance are decreasing through the years. We only see Eni and Petrobras in 2022. But this could change as more mergers are happening in acquisitions, and this can modify the scenario. And then finally, our last key insights of the night. We see that we have ESG initiatives in upstream operations, but they are mainly focused on Scope 1 emissions, methane emissions, and they have aggressive emission targets. And that's it, our key insights for today. I'll hand that to Joe, and enjoy the panel. Thank you.
I think we're going to maybe keep that. Yeah, thank you. Okay, thanks for being here. I'm Joe Quoyeser. I'm not Uday Taraga, so I'm Joe Quoyeser, a friend of Uday, and I'm going to moderate this panel. I'd like to let each of the panelists introduce themselves briefly, and we'll get into the content of the discussion.
Great. So I'm Will Atcheson. Let's move that up. I'm Will Atcheson. I am the energy specialist and strategist at Jefferies. It's a little bit of a unique role. I run my own facilitation book. I also work closely with banking, and I work closely with sales and traders. I just wanted to highlight Jefferies, some of our capabilities. So we have an unmatched banking team, very extensive. In fact, one of the people up here knows a bunch of them. And then next slide, please. Just wanted to highlight, in the equities, I guess my pictures didn't show up. Good for you, you don't have to look at me twice. Lucky you all. So look, I also wanted to highlight our equities. So we have II ranked, of course, equity research, and then we have some of the top equities. Very deep in energy, the transition, oil field services, midstream, the whole vertical, the whole horizontal, however you want to define it. And super excited to be here discussing what's going on onshore.
I'm Michael Pipkin. I'm the founder and CEO of Rushmore Resource Partners. We're a private equity-backed upstream oil and gas company with assets in the Midland Basin. We're in Reagan, Upton, and Crockett County. We've got about 75,000 acres. We're a cash flow value-oriented company focused on a lot of the things we're going to talk about today. So it's a pleasure to be here.
I'm Brent Williams, Director of Sustainability at Callon Petroleum. We recently announced a few weeks back that we were going to be acquired by Apache, so working through that process now. Callon's a small cap E&P with assets in the Midland and Delaware Basin. Historically, we had some assets in the Eagle Ford as well. We sold those a year or two ago.
So let's start on the topic of consolidation. Brent, apropos of what you introduced as well as Uday's overview of the domestic sector, I think consolidation is clearly the most important and powerful force shaping the market right now. Kind of like just go down the line here, start with Will, and just give the audience your kind of view of the one or two forces you think are most important in shaping and driving this consolidation.
Sure. So I mean, a high level, I would just point to that Shale 3.0 that we discussed just, 2 minutes ago, right? This evolution in the free cash flow into a mature business. But really, what does that mean, or what are the underlying drivers? I think there's really two parts. One, people are looking to lock up the top core resource. And what do I mean by that? I mean, look, after decades of just always finding new shale plays, always finding new productivity improvements, finding new benches, even international offshore, right, Guyana, et cetera. After all of that, I think people are finally getting to this idea that maybe we've kind of delineated the plays. Maybe we're not going to be finding the next Permian anywhere. Maybe we need to be locking up some of this core resource rather than spending exploration dollars. So that's one. And then the other is just the economies of scale, right? As you get larger, you can get things cheaper, you can negotiate with oilfield services, suppliers, et cetera, but there's also the other part. You can drive out G&A, you can drive out other costs. And then again, of course, if you're larger, it's easier to have a discussion or a seat at the proverbial table when you're talking about potential new pipelines with midstreams, when you're talking about potential egress issues, when you're talking even just about, the prisoner's dilemma of should I grow or should I not grow. It's easier for the prisoner dilemma to have an optimal outcome with less actors. So that's also what's kind of driving this consolidation.
Well, I think you covered pretty much a lot of the rationale behind the wave of consolidation. The one thing that I'd add to it is, I think that where we are currently reflects a commodity price environment that's slightly more favorable for transactions than in periods of extreme volatility. Like, I think anyone who's a natural gas producer would maybe say there's been some extreme volatility recently, but on the crude side, it's what crude's been trading within a range where buyers and sellers, I think, feel slightly more comfortable transacting than in periods where there's dislocation to the upside or downside. So I think the overarching point that Will made is the right one, which is this focus on return on capital, which really started to become the guiding principle in the mid-teens, maybe a little bit too late teens, but you can't really be profitable, high margin business focused on returns if you're not very efficient, and this business scale helps. So there is this race to get bigger, and you see it at kind of all levels of the food chain. And so as we think about this, like, I'm probably at the bottom of that food chain in the Permian, but certainly even at the smaller end of the spectrum, we're always thinking about how can we increase scale to improve our profitability, and that only becomes magnified when you're a public company with scrutiny from your investor base.
Yeah, I'll agree with the other panelists. I mean, I think I've been at Callon about 6 years, and it was 15,000 barrels a day probably when I joined 6 years ago, and we topped out over 100,000 barrels a day. And what we saw through our growth, and that was predominantly through acquisitions and mergers, was as we built scale, we were able to increase the efficiencies. So as you build scale, as your capital program gets bigger, you're able to optimize the number of rigs that you're running with your completion crews so that you can have continuous rig lines, you can have continuous completion crews. And that just compounds as you get bigger. That ratio gets better, you're able to smooth out your production profiles, and there's operational benefits to that. The technology that the industry has come up with just continues to improve. So reservoir engineers are able to do more with the tools they have available now. Drillers are able to drill faster and more efficient with the tools they have now. So we've seen just the technology of our industry improve to a point where people are able to do more and be able to influence more and just be able to produce more with the given number of people. So just that efficiency is meaningful. There's also the trading dynamics right now is you see the trading multiples of companies. The larger companies are trading at a premium to smaller companies. So there's just a natural desire to increase your trading multiple and improve your stock price, right? That's natural, and you see almost a linear progression with scale to that. So those are two big ones. The other one I'll add is there's a natural evolution of private equity. So we saw the graph earlier where the number of private equity companies out there is much smaller than a couple years ago. So there's just a natural evolution of those private equity companies that they'll grow, they'll mature, and then they'll seek to monetize. So this past year or two, we've just seen that life cycle of PE, just everybody hit that sale point at the same point. So you see this consolidation also happening just in the evolution of the capital providers and that aspect.
I spent most of my career in management consulting, so I want to dig in a little bit more on the industry structure kind of elements of this consolidation. And the point, Brent, you made about valuation multiples is kind of interesting, and maybe we can pull on that a little bit more as well. So, one observation is that the two most recent Permian transactions were announced were both large privates acquired by public. So Crown Rock to Oxy, and then Endeavor to Diamondback. And Crown Rock and Endeavor, really large companies. I mean, they're probably both bigger than Callon. They're both, I think, near the top of the league table in number of rigs running. So the cynic might say, hey, they're already at that efficient scale in terms of optimizing rigs and fleets. There clearly could be exit considerations of highly concentrated ownership in both cases. A lot of principal investing kinds of considerations, but these companies are much larger, order of magnitude larger than, say, Diamondback and Laredo were when they IPO'd 10 years ago. So I guess two-part question. One, what's the source of this valuation discount that makes IPO kind of unattractive? And secondly, do you think we'll ever see another IPO in the U.S. oil and gas industry?
Start with me?
Yeah.
Great. Rats, would have loved to hear one of you first. No, look, I think it's a great question. So let's start with the second one. Will we ever see an IPO again? I think on the margin, you're going to see people rather looking to sell to already public companies. But I wouldn't say no more IPOs ever, just because I think there could be niche, unique situations where potentially they really like the acreage, they have a differentiated view, they don't think anyone in the public's going to pay for it until they prove it up or grow it to a certain scale, et cetera. So no more IPOs, I don't want to say that, but on the margin, incrementally more likely to get acquired, I guess, would be one way. And then really what's driving this, I mean, it's hard out there to be an energy investor, right? And it's really hard out there to have someone who's tied their equity to energy and crude prices. So one of the things that might be nice is getting bought by someone who already has a high liquid stock, who already has a high multiple, and whose management team is trusted by the market. That gives you a de facto trust, right? You know XYZ, you trust him or her with your capital already. They're going out and acquiring this. You're not the reservoir engineer, you're not a petroleum engineer, but you get this team, you understand it. It's like, just talking for your friend, vouching for your friend, right? Like, this person's good. I think that's part of it. So one, the ability to get liquidity pretty quickly, and two, the ability to not have to go and pitch a new complex story by yourself when energy investors have just been burned for a decade. We've gotten better recently, but remember, we didn't have positive free cash flow returns for the first 10 years of the shale because the theory was growth. The market will pay for growth. Demand in WTI/Brent, those prices are always going to be higher. We're always going to need more oil, so grow. And then it turned out, hey, maybe we need to not be thinking about growth turning over in the next decade, but maybe we don't need to be chasing growth only. Maybe we need to be chasing free cash flow. So I think we've just got a little bit negative sentiment out there from the investment community, from the market. And I think it just makes it easier to go with someone who's already vetted, who has liquidity, who's a large cap, and who's already executed. But really, really excited to hear what else they're going to say.
Well, I'll just add, I think to your previous point on, the fact that we're in Shale 3.0, like that is what the public equity universe is currently valuing from, a potential public issue or so. Joe brought up Endeavor. Endeavor, for example, could have been an IPO candidate potentially, but, Endeavor was Autry's company. So I think that from the point of view of, how does he exit, I think that really comes back to a lot of Will's points. So if you think just about the landscape of companies out there that meet those criteria to be a public company, the universe is extremely limited. Maybe Mewburn comes to mind, but again, kind of, family-owned businesses, assessing what the relative attractiveness of their options. So then if you look at the other landscape of private companies out there, the list of even companies that meet those key metrics of scale, profitability, they're just extremely small. So I think to Will's point, there may be some niche new public companies. How they get there will also be interesting. A regular way IPO is probably going to be unlikely or extremely rare. So I don't really see a universe where there's a new list of public E&P companies anytime soon, at least as we've thought about IPOs in the past, and I think Will brought up good reasons why.
Yeah, I just, I can't speak to Endeavor and Crown Rock and some of the others, right? I don't know those companies as well as some of the others on the panel, but conceptually, oil and gas is trading at pretty low multiples in the history of things. So, not the ideal time to go public. This isn't the first wave of large, closely held companies that have sold to public operators. You had the Yates family, Bass family, and others, right? So these tend to come in waves over time, and I think the point was made earlier, stable commodity price is more conducive than high commodity price or low commodity price. It's that stability which allows transactions to happen. It lets the buyer and seller come to the table together and agree on a valuation. So I think we happen to be in one of those points in time where the commodity has been stable enough for long enough that lets people think about monetizing and they can make the decision on now is a good time or if they want to hold on to it longer. But there's other factors when you get into private businesses in terms of liquidity and things like that.
Another way to look at industry structure, just strictly from a public lens, is Pioneer is a company I know well. Maybe all of us may know it well. And there was a long set of rumors about Pioneer and Exxon. They finally came to fruition several months ago, and to me that's interesting because you have by far the largest public pure play Permian focused, essentially saying there's no future. We're better off. There's no future in our strategy. We're better off joining up with Exxon. And there's a long list, not as long as it was because Callon's off it, but there's a long list of public companies that are Permian focused or Permian centric that are a lot smaller than Pioneer was at the time that announcement was made. I mean, a non-exhaustive list would include Matador and Laredo and Oventive and niche companies like Riley and Ring, and so part of me wants to say, well, all those companies are kind of on the clock, or they have to justify their existence as a continuing enterprise publicly at a much smaller scale than, or get bigger, but than Pioneer was when they took their chips off the table. So does that make sense, or what am I missing in that framing?
Yeah, I think every company is different, right? Every management team has their stakeholders that they're trying to increase and create value for. I think there's differences when you start looking at when two companies come together. A purchase is different than a merger of equals, right? Sometimes there's different ways to get to valuation, and sometimes an outright sale for cash is different than a kind of a stock for stock sort of a thing. So there's different motivations, and I think each company is at a different life cycle, and if somebody feels they have value still in the ground that they're able to monetize, bring to the surface to then get more value in the market or in the M&A market. I think every company is so unique in that aspect.
Yeah, I agree. I think we'd have to make a case-by-case analysis of each company, I think, to go through and decide whether or not it's a good going concern as a public company. And I don't think we should go through that today. But I do think, to Brent's point, right, there are companies out there that, currently as they exist, look like they'd be more profitable as a private entity. And there are just challenges with making that a reality. And that's where some political, social issues can always, board issues can sometimes impede that. But without knowing kind of the nuances of every company, they thus exist as public companies. And I'd say, one thing that is the real positive of Shale 3.0, some of the positives of how Diamondback has performed post-merger analysis or announcement is you've seen more interest in the public space, still limited, coming back into the oil and gas sector. And from my point of view, lessons learned from the last decade are the reasons why. And so some of these companies that are kind of at that lower end of the spectrum, hopefully they are focused on profitability, hope and growth, because ultimately when this industry, which is cyclical, becomes more cyclical, like some of them, may not be around when kind of that turn happens. So thus Joe's point, there's got to be motivation for consolidation, and hopefully that continues to occur. And because I think it's in the best interest of public shareholders, which is in the best interest of the industry longer term, to continue to attract capital.
Let's look out, say, 18 to 36 months after this wave of, this current real bow wave of deals closes. One of my observations in my career is the industry has been somewhat stubbornly fragmented, or say differently, not as much consolidation ever happens as you think is going to happen, and that's because they typically are followed by waves of portfolio rationalization and divestments. And examples of that, when Oxy bought Anadarko, they sold off the Southern Delaware Basin, which essentially created Colgate, which started Permian Resources, which is now a sizable company. When Concho bought SVP, they sold the Northwest Shelf to Spur and J. Graham, and that's now quite a sizable company. Do we expect that to happen in this wave? Is anything different, or do you expect portfolio high grading, rationalization, divestment of non-core assets, or lower focus assets?
I can start on that one. I think it gets back to people. At the end of the day, we're all sitting in this room, we're all working in different parts of the energy and energy-related industry. We all have families to feed. We all have ambitions to retire at some point, probably. And what you're going to see is, as all these companies get consolidated, there's a lot of people that are going to be trying to figure out what's next for them. And you see this as the cycles ebb and flow, where a company will get acquired, those people then go on to start something else. That entrepreneurial spirit comes out. Now, capital has to be available for that to happen. Assets have to be available for all those things to come together. But inevitably, over time, it happens. Some people leave the industry and go on to other things, but a lot of the friends I've known in core oil and gas companies have gone on to energy transition, which is kind of oil and gas, akin. So I think when you look at people, the people have ambition, and people are going to start companies, and people are going to find what's next for them. So if it's looking for these assets that are going to get divested, if it's looking for new startups in energy transition, if it's looking for new technology identification, the people are out there. They will find the capital, they'll find the ideas, and then you'll see this new wave of businesses grow. So I think we'll definitely see it. I think it always takes longer for these assets to get shook loose from the consolidated company than people think, but at some point it tends to happen. And as companies get bigger, the threshold to press release these announcements gets bigger as well. So, there's folks I know at some of these large super majors that have sold sizable assets off of their portfolio that they're immaterial to those big companies. So you don't read about them in the newspaper like you do a consolidation of two SMID caps or something.
I think there's a lot of private capital. Well, less private capital than there used to be, but hoping on that thesis that assets come out. Rushmore is one that wants to continue to acquire and grow. And I think there's really, though, I think, two different categories of assets, and I think one of those is, particularly from the larger public companies, we've seen divestment of assets that are late life. Depending on what lens you look through it at, it may be a liability, it may be an asset. Like, it's ultimately, how do you extend the margin of this so you don't own the liability longer term? That's not something that a lot of companies want to own. So it'll be interesting to see, how that continues to progress. But then I think what's the more interesting topic is really the portfolio rationalization post-merger. And I think Will brought up a great point, which is a lot of these companies are now buying areas that they think they've really delineated well. They want to own it, right? So in those areas, you're unlikely to pry assets loose from them unless there is a reason why, like a time clock on a lease, and they can't get a rig on it, and it doesn't rank, and so you've got to be ready to step up and to win any type of marketed process, and every process is competitive, to differentiate yourself on valuation based on those types of opportunities. And then, I think there's ultimately going to be a third category, which is, non-strategic assets that are just not part of the, pro forma portfolio that they divest. But, with where balance sheets are today, leverage is almost, universally sub one times for most healthy companies. There's not a sense of urgency. So there needs to be a real value proposition on the buy side in order to pry those assets loose. At least that's, what we've been seeing.
Yeah, I would just agree with that, or echo both their comments. At some point, something will get cheap enough that it will be accretive, right? So these assets are going to be moving. It probably takes a little bit longer. Maybe some of them that historically would have been bought, maybe these go into, there's this thing of royalty trust. I've been really interested why these things haven't been used more. Why not spin out some royalty trust for some of these mature assets and make it so that you get the tax advantage of that? Things like that could potentially be interesting on the margin. But again, look, private equity maybe not stepping in as much as they were 10 years ago, but they've still got billions of dollars on the sideline. There's still family offices who have made billions of dollars selling. I would be hard-pressed to believe that anyone at Crown Rock or any of the other privates who were bought is not going to go out and start something again in the next couple of years. I wouldn't believe it. So maybe they'll be grabbing some of the stuff that they own historically that don't rank, with the current company they're at. Or maybe they'll be moving somewhere else and gobbling some of these. I don't think it's over. I think it's slower. I think it's not as large. But look, like he said, oil and gas is entrepreneurs. And I think they'll find a way to make money.
Michael, your balance sheet point's a good one, and it actually, my Oxy Colgate analogy was completely different, right? Oxy was in a very compromised balance sheet position then and had a sense of urgency to sell assets. So it's a good point that it may take a little bit longer. Michael, let's dig a little bit into Rushmore. We're about 3 years and 4 weeks on from your closing your purchase and sale agreement for EP Energies. That was, I guess, characterized as a basin exit rather than a portfolio. It was a portfolio change at the corporate level, a basin exit. So you were able to, you and your partners were able to buy a substantial asset. Over the 3 years, kind of what, at a summary level, kind of what's gone according to plan, what have been the positive surprises, what have been the headwinds for you?
Sure. So I think the biggest surprise, just to back up a little bit, is just that we acquired assets in the Midland Basin that met our return criteria with kind of our underwriting criteria. So, Rushmore today, we're an upstream oil and gas company. I'd say, prior to becoming Rushmore, we were an investment thesis that you could acquire long life, high margin producing assets for PDP only for historically attractive discount rates, use leverage and hedging to produce equity-like returns for credit risk. That was the very short version. And so the thesis, that we thought could yield those returns was going to be acquiring assets that were later lived assets in areas like East Texas, Arcoma. And so in order to acquire that asset in the Permian, that was the biggest surprise for us, to be honest. But it was a period of dislocation in the market. We had a motivated seller that was emerging from bankruptcy that wanted to pay down debt. So kind of things lined up for us to be able to do that. post closing that deal, I think it's related to the first premise is that what has been a positive surprise for us is that we've started to see development start to move farther south in the Midland Basin, and I think this ties into a lot of the themes here today, which is as the core of the core starts to be more developed, as the larger companies start to consolidate the premier positions, you see the more entrepreneurial folks that this industry continues to spin out start to look at newer ways to create economic returns that meet their economic objectives in areas that like ours had been probably developed with kind of the wrong strategic objectives over a period of time. So when we looked at this asset, we didn't value any of the upside when we closed the deal. I mean, prices were low, so everything was probably uneconomic at the time. But certainly just from a geological point of view, I think you're starting to see lower D&C, differentiated completion designs, and a lot more activity from both more nimble public companies and some of the kind of more entrepreneurial private companies in the area. So that's been a surprise. Yeah.
Good. This question would be maybe more directed at Brent and Will. We've seen some slides from ADI on ESG broadly defined. We had a COP28 slide. We just saw a slide on U.S. onshore, kind of different environmental initiatives. So if we take these words, ESG, environment, social, and governance, I kind of want to dig into that and maybe ask three questions, and you can pick up which one is. First of all, looking out, say, 3 years, do you see any big changes in the weighting of executive effort across E, S, and G? And then double-clicking on E, where do you think the center of gravity might be between emissions and water and other considerations? I have a third question, but I'll let you dig into those two first, and then I'll come back.
Yeah, I'll kick it off. So I'm Director of Sustainability at Callon, which, the company has had those ESG objectives for a number of years. That's not new, but my specific role at the company is new. And my particular focus was to consolidate a lot of the efforts to, reduce emissions, to model it out. My background is kind of corporate development, strategy, planning, budgeting, those sorts of things. And one of the things that I find very encouraging is that as the companies focus on the environmental part, the emissions part, it's helping to improve the rest of the operations as well. If you think about it, the emissions coming from a particular activity is tied to an activity, and that activity also has a production impact, an LOE impact, and a capital impact. So effectively, all we're doing is adding one more output from an activity, right? You drill a well, it's going to cost CapEx, it's going to create production, you're going to have an LOE, and then it's going to have an emissions component. So effectively, what we're doing is modeling one more output and figuring out how to optimize it. And it's as we've done that at Callon, what we found is there's other opportunities that come from that help our operations. So we've found ways to reduce emissions, but it increases our production as well. So it's not purely a cost. There's a revenue side of that equation as well that's been kind of exciting to unwrap and see what that produces. For example, one of the kind of in the energy transition space, I'm looking at opportunities to develop solar projects on our acreage to support our assets. And it ebbs and flows with the price of electricity, but what I'm finding is that I can develop a solar project, generate electricity for cheaper than I can buy it off the grid, plus I get the Scope 2 benefits of that. So in my role, what excites me is there's opportunities for our industry to focus on the E part, but it also helps our fundamental business. It creates more production, it lowers our LOE, it does all these other things in addition to the environmental benefits, which is a piece as well. So that's been encouraging to me. I do think, to one of your points, I think air emissions has been a focus kind of over the last few years, I do see water as a focus going forward, in addition to emissions. As the industry matures, just each of these variables start to get refined, right? We started with the air emissions because that was kind of first and foremost, and then, okay, most people have a feel for how that works and how that, kind of the key variables there. Okay, so now we're moving on to the next thing. So our industry is just continuing to mature over time.
Yeah, that's great. So, I just came back to Energy December 4th. And for the last 2 years before that, I was actually one of the leaders of ESG at Jefferies. We were II ranked #1 globally, for whatever that's worth. And the message that really resonated here is ESG is value, not values. I want you to think about that very carefully. What is material and what is not material? So there are things in ESG that are material. I would argue water access in the Permian is material. In 2018, you saw hedge funds position going into Q3, specifically around water access. That was, I'm sure some of you remember, Jagged Peak was building its own water. Other people were building their own water. These were things where it was materially impacting two things: the ability to execute on your development and capital plan, and the margins. Right, so that was material. Water was material there. Today, GHG emissions are material in as so much as, one, the methane tax, and two, you might get some negative sentiment. Realistically, that negative sentiment doesn't do much. So in my mind today, the E is where we're focused, and we're focused on water. We're focused on water because we need it to produce. There's earthquakes in Oklahoma, so you need to be careful about how you dispose of it. And then, of course, the whole social justice, you taking water from Odessa to pump wells. It's a very interesting question. I'm not smart enough to answer that. Seems like there's more water than, seems like we're fine in Odessa, but I've heard that before. So I want to answer, so to answer you, E is where we're focused today. G will continue to be an issue. The beautiful thing about US onshore is we're a very stable country, knock on wood. So I think, when you talk about the governance, that's always important. It's always material, but it's a little less material here. And then on the S side, it's interesting, human capital, labor, the cost people are paying to get oil field service workers, those are material. But let's be real, we just pass those costs off. So OFS raises the price until they can, and basically what happens is upstream then says, I can't drill anymore, this is too much, or says this is fine and pays it, and the oil price creeps up. So really today, I guess to answer your question, E is where I'm focused, water is where I'm focused. GHG emissions are very interesting, but absent a price on them, why as an investor should I care?
Interesting. Okay. I want to just give the audience a chance to ask some questions. We've got about a few minutes left here with this panel, so if anybody in the audience has a question, we'd like to give them a chance now.
I thought all your comments about the M&A in the Permian were really interesting. I just was curious if you have thoughts on any other basins, if there's any more consolidation, particularly thinking about some of the gas basins, like in the Marcellus Haynesville, we just saw Chesapeake and Southwestern. If there's any other, if you have any thoughts on potential targets there. And then I thought your comment was really interesting on the stabilized oil price kind of accommodating the consolidation that we're seeing in the Permian. Do you think that gas prices obviously have been on the other end of the spectrum? We have LNG coming maybe 25, 26. Do we have to wait for that to materialize? Then maybe we'll see some more consolidation. Just curious on any of your thoughts on that.
She might be looking at you, Will.
Yeah, sure. So, look, one, I just want to reiterate what Michael said. Look, steady prices help. Henry Hub, I guess, has been kind of stably down for the last 2 weeks, but not necessarily stable. It's very cyclical, it's very seasonal. I think that makes it a little bit harder. Chesapeake and Swanee had a few great things going with it. There's acreage overlap, et cetera, but there's also LNG exports and the ability to fill some of this capacity. I think that's going to be more of a driver of M&A in natural gas basins rather than a conducive price, right? I think it will be more about, hey, we have the ability to have takeaway, hey, we have egress. this could potentially be a good merger. That being said, I mean, I think when I'm thinking about the next M&A wave, I think it's tier 2 assets. And what do I mean by that? Yes, some in the Midland, yes, some in the Delaware, so your traditional Permian, maybe moving a little fringier. But you know, Reuters reported Devon and Enerplus were looking at a merger, or I think they said Devon was acquiring, still just a Reuters article, but it brought up an interesting point, right? It's like, does tier 2 Bakken compete with tier 1.5 Permian? Especially if you already have infrastructure there, where the infrastructure is slowly being underutilized. So you have the ability to expand margins on the Bakken, you have the ability to go buy something that's not as rich as you would pay in the Permian. So I think, you know, natural gas, I think we need more. I think you'll see more. I think there's a little bit of a lull while we wait for the gas fundamentals to come through, outside of potentially egress solutions catalyzing these, I guess, corporate decisions. And then outside of the Permian, I mean, I'm watching Bakken. Eagle Ford's a little mature. Although Eagle Ford, there's some really interesting recompletions and EOR being done there that really I don't understand, but people smarter than me are very excited about it. And so I'm watching that very closely. So I think Bakken gets interesting. You know, Scoop and Stack, haven't heard that in a while. Maybe that comes back at some point. Maybe. I mean, we all remember the Tuscaloosa Marine Shale, so maybe not. But I think, yeah, I think it's more of tier 2. I think we're stepping out of the core. I just don't think there's that much core left. And I think you see MOEs, because the big dogs have all gone out. They've all spent money, and now they're kind of talking about how do we get our leverage where we want to be again.
Yeah, I think you covered, you know, a lot of it. You know, I think the only thing to mention in addition to that is there will be another wave of private capital. So, you know, as you've seen this portfolio rationalization occur, I mean, there are billions of dollars. So the question is what will that private capital do in addition to what's going on in the public landscape? And I think to your question on the gas side, you know, there's going to be I think scale will continue to be an important concern, but in times of dislocation and rapid reduction in gas prices, you know, I think there's going to be probably idiosyncratic reasons for companies to consider merging, but there's not going to be a wave of gas companies merging in that type of environment. But you know, what I'm interested to see from, because I'm the private voice up here, is really what does private capital do next? You know, will it be re-entering the Mid-Con? Will it be looking at, you know, acquiring more mature Eagle Ford assets? Because that will be the next wave of, you know, what we're focused on is cash on cash returns for our investors. You know, we have to make you know, a realized return. It's not just public equity. So,
yeah, I'll add to that. You know, if you think about the public market, right, you can pay for a transaction in cash or shares predominantly, right? So if gas prices are way down and the gas companies think their shares are not worth what they feel they should be worth, you know, you're not going to issue shares to buy something more than likely, right? You could merge with somebody and do a merger of equals, where you can come up with a relative valuation between the two companies, but that typically takes companies of a similar size, right? You could issue shares to a private company and take out a PE sponsor, right? But those, you know, the company issuing the shares would have to believe that they're getting a good value for that, so that's kind of a private to public transaction. So when you get big swings in prices and people feel that their equity is undervalued, they're less likely to issue than if they feel it's overvalued. So then you get into MOE, and then there's only certain companies, because fundamentally you have to have a industrial rationale. You have to have synergies. You have to have a reason to combine with this other company, not just because you want to, right? You're trying to combine to get synergies, to save money, to increase efficiencies. That's fundamentally why you join two companies together. So if you don't have that, that's the starting point. And on gas in particular, because it's so tied to a commodity that you have to put in a pipe, as opposed to crude, which is, you know, slightly different.
So this question is for Mike. I'm curious, right? So when you are looking at some of the dynamics that we are seeing in pricing, where oil prices are reasonably high, but gas prices are quite low, and let's say you're operating an asset with significant associated gas production, I guess how does private capital think about continuing to produce or grow in that kind of an environment versus, let's say, some of the other publicly owned companies?
So I can only answer for Rushmore, and we're probably a little bit atypical. And we're, a margin-focused business focused on cash-on-cash returns for our investors. So we are always actively hedging all the time. So we're looking at opportunities out, pretty far out on the strip for to put positions on that protect cash flow for our asset and for our investors. So we always want to be able to ride out periods of near-term dislocation in the market. So today, we're unaffected by what's going on with Waha. And, I think that that puts us in a position where we can be opportunistic, which is, kind of our strategy, which is be opportunistic when we can be. So I think that if we did not have that mindset, our position is interesting because, as you go from the northwest to the southeast, the GOR increases significantly, but, it's still economic to produce natural gas because of all the associated NGLs. So you have to look at things on a three-stream basis. But, we have on our asset the ability to basically bank gas if we don't like the price environment. We have an EOR project that we didn't pay for, but we bought. So we'll re-inject gas when the market is really not there. But because of our hedge positions, we really don't have to make that decision. I think it's a tough environment out there right now, particularly for Waha producers. And it gets to one of your slides, which is, I hate this term, but it was the term from the mid-2010s, which is the free gas era of the Permian, and that's a scary thing for natural gas producers. You don't want to hear that. So hopefully companies are really looking at full cycle rates of return and also being thoughtful about the environmental piece of this, which we agree with Brent's point, which is environment and margins are aligned, from our point of view. So we want to be selling every molecule of gas that we can produce. We don't want to be flaring any of it, and we've reduced flaring just really significantly.
Or venting.
Yeah.
Hey, I'm going to ask one last question, and Michael, I didn't prep for you this, but I'm reminding you, since we were counterparties in 2021, this is a question I asked you 3 years ago, so I just want to update the question.
All right.
How bullish or bearish are you about the availability of bank credit for expanding your business?
So I'd say, generally speaking, there's two kind of thoughts on that. One is, for high quality upstream oil and gas companies, there is credit out there from traditional lenders, and the universe of lenders today has shrunk. There are fewer banks that are supporting upstream companies. It's a real challenge, and it's something that you have to monitor as a company, because even if your company's performing well, there may be issues at a bank that's a mid-market bank post Silicon Valley. You have no idea what's going on across a bank, and so there's always something to learn there. But I think with this rate of consolidation, and particularly a lot of these private and public companies that have been acquired, there are banks that need to put new dollars out to keep their portfolios flat. So you kind of have the tension between those two things, and I think that if you're running your business the right way, you'll be able to find bank debt, but it's increasingly hard to come by, and you have to think about how can you provide revenue to a bank across multiple streams. It's not the old days, like you could be like, I need a zero borrowing base tomorrow and get 8 term sheets. Like right. That's not the era we're in anymore. Yeah.
Well, thank you all. Thanks for your attention, and please give a round of applause to the panel.
Thank you.